Welcome to yet another Tools of the Trade webinar. I'm Jan Muta, Chief Market Analyst for TO Markets, and in this webinar series we have been looking at momentum. And why is that? You know, if you are a trader, you need to get the momentum right in order to understand the market. So I'm talking about the directional moves in the market. So you need to get those moves right in order to be a successful trader. And here's an example. I could have picked up any chart I like, but I chose this one, mainly because I published analysis here and again here, suggesting that this market has upside potential. Okay, we don't give investment advice, therefore I can't say, okay, I think this is a buy here and you should be going long. But instead, I'm looking at the market, I'm seeing certain things in the momentum taking place. I'm using certain tools to understand that now we have an opportune time to actually publish analysis on this market and say there is upside momentum, upside potential here. So if you want to learn how to do this, if you want to learn how to catch moves like this, then this webinar is for you. And there's something else I'm sure you love. And this is our VIP Black account. It's an amazing environment for your trading. You get very, very, very tight spreads. You don't pay commissions per trade. And there is no monthly subscription fees either. We dropped those too. And if you want, you can have the option of TO Shield, which basically means that you pay a little premium and then you have a small time window during which you can decide, okay, I don't like this trade, and you can close the trade without a loss. The only two things you pay is the insurance cost and the spread. Not too bad, right? So go to tomarkets.com/contact and ask for more details. Our people are so friendly. They are so happy to help you out. And yeah, that's it. Go there, study more, and I'm sure you like it. Now, in this workshop, you will learn to measure momentum and recognize changes in momentum. Obviously, if you have the tools for measuring the momentum, and then you are better equipped to go and see when the momentum changes are significant, when the market is only pausing on the way up, and when it's actually creating a top or a bottom and is actually going to reverse. So this is what you need. And this is why I put this together. So obviously this will help you to make better trading decisions, but there's something more. Especially in this webinar, I want you to learn to read the markets without indicators, without those squiggly lines going up and down, filling up your charts, and sometimes prohibiting you from seeing something vital that you need to understand in order to judge where the market is going. Yeah, indicators do have their place, but if you have too much of them, they can be a problem. Okay, in this webinar series, we have been looking at the indicators. So they have their place, but you have to use them in moderation. So we have been looking at moving averages, oscillators, trend lines, Bollinger Bands, and now we're going to take a look at price action itself. The very fact that drives the indicators. Indicators don't move the prices. Indicators are just mathematical formulas that have certain inputs, i.e. open, high, low, close, over a certain period. Depending on the indicator, it might be just close only indicator. It doesn't need open, high, and low values. But then, whichever way they have been built, they are just dependent on what the price does, and then the indicator value changes. So always pay attention to what's happening with the price. So that's why we need to understand trend structure, price formations, higher lows, lower lows, etc. So this is what this webinar is about. And I will also introduce you to something that most people ignore. And they don't really understand that it is a very effective tool that will help you to understand more easily where the market is going. But then I'm not saying this is going to be the only one. You need to understand how to use the moving averages, how to use trend lines, support and resistance levels. And that's why you have had those previous webinars emailed to you. You can go back there, review them. And obviously there are lots more new webinars to come. And I'm excited to teach you. That's basically what I do. This is what I love to do most. It's nice to study the market. It's nice to write articles. But when I get to teach you guys and I get your feedback, when you're saying that, oh, now I understand this, then that's highly, highly satisfying. It's very rewarding. So I enjoy these webinars. That's the reason I enjoy these so much. Okay. Briefly, here's my background. Started as a futures trader for a hedge fund in London, then have worked in various roles over the last 20 plus years. And now, as a chief market analyst for Tio Markets, I'm here to help you. I'm helping you via my analysis and trader education. And obviously, like I said, if I can see you succeeding, if I can get the feedback from you that you are a better trader today than you were yesterday, if you are learning new things, that equals success to me. Nobody becomes a successful trader overnight or in a couple of weeks. It's a learning curve, and that's where I am to support you with this learning curve. Okay. Now, please watch this webinar, attend this webinar, watch this video only if you agree with this disclaimer and with the fact that we don't provide any investment advice. Okay, you can take a screenshot, you can pause the video if you're watching this afterwards, but yeah, that's the deal. We don't provide investment advice. All right. A very, very brief recap on what's momentum, because we might have people who haven't been to the previous webinars. Momentum defined scientifically is rise over run. So you have the y-axis here. In the charts, it's usually dollars, and on the x-axis, we have time. So if the market moves from this point to that point, there's 2 units of movement in y-axis over 3 units of time. So this gives us a certain slope, 2 divided by 3. Obviously in markets you might have some very steep rallies, think of GameStop or Tesla, but those rallies, they tend to last for a while and there'll be pullbacks. And depending on how you measure the momentum, you can either participate in those or you can't. But that's what this webinar really is about. So stay tuned, and obviously stay tuned for future webinars as well, because I have so much more to teach you guys. Now, take a look at this. Isn't this amazing? Isn't this amazing? Most of small traders never stop fighting the market. Yeah? That's worth repeating, really. Most of the small traders never stop fighting the market. You know, one of the things I was always taught from the beginning is, and that's that you have to go with the flow, go with the trends, go with the momentum, the main momentum in the market. But most of the small traders do exactly the opposite. They just fight the market. So if the market is trending higher, they try to find places to short. If the market is trending lower, they are constantly trying to buy. And often, most of the time, it just doesn't work. You just lose money. But there's no reason to fight the Mrs. Market, like I call her. The reason I call her Mrs. Market is that, we are, at least, me and my trader colleagues and friends, we spend more time with the markets often than with our wives. Yeah? So we're kind of married to the Mrs. Market. Yeah. But Mrs. Market is a special kind of lady. She doesn't tolerate disagreement. She'll destroy you. Seriously, she'll destroy you if you disagree with her. She takes out your account in a jiffy. It just goes like that. So, when you're married to Mrs. Market, you trader there, it basically is a marriage where Mrs. Market says, I want to go up. Then all you can say is, yes, dear, and go long. And when Mrs. Market says, I want to go down, then all you can say is, yes, dear, and short the market. And that's kind of simple, isn't it? I'm thinking this as a marriage where, in some marriages, the guys are the ones who set the rules. Okay, this is my house, we do things my way here, and you either listen or you suffer. In this marriage is the exactly opposite. So imagine a lady walking down the street, Mrs. Market goes there, and your options are quite limited. The only thing you can do is to follow, like a puppy behind her. So never forget this picture. I'm spending a little time on this so that you can get this picture on your mind, that you are not the leader here. You are not leading the market. The market is leading you. If you try to fight against it, it will take you out. As simple as that. So, I'm going to talk to you about some analysis methods. And before we do that, I want to emphasize this. Whenever somebody presents you something, and believe me, there's a lot of stuff in the internet, and most of that is rubbish. I know that after 20-something years experience, and the amount of rubbish in the internet is increasing all the time. There's some good stuff there, but how do you know what is good and what is bad? So you just don't have you just can't afford to go there and pick up something and then start trading on it. You need to make sure your analysis method, whichever analysis method you choose or somebody presents to you, it's got to be something that adds value. So I'm going to give you a couple of criteria here that help you to decide whether something is actually adding value to your trading. So here we go. Criteria for an analysis method to be useful. It's got to be robust enough so that it's useful in most markets. In most market regimes. A market regime kind of refers to the type of market that there is. It might be an uptrend or a range, so kind of bottoming or a topping range, or it might be a downtrend. But then you have these subcategories. You have volatile uptrend. You have low volatility uptrend. You have volatile and low volatility ranges. So if your analysis method is robust enough to be useful in all of these market regimes, it's an enormous plus for your trading. It can be good if you only trade uptrends and never touch the ranges and downtrends, then it's okay if it works only in uptrends. But I'm saying the more market regimes, your analysis method can be applied to, obviously, the more opportunities you will have. Then it's got to be whatever phenomenon you are observing and looking for, it's got to be frequent enough to generate several daily or weekly signals, depending on whether you are an intraday trader or a swing trader. And then general enough to be valid in multiple markets. If your analysis method is valid only in, say, GameStop, stock market, in that stock, it's going to be difficult to make money with it because the opportunities don't come that often in that one single market. But if you have something very general, you can go take all the free markets, really, freely traded markets, commodities, currencies, stock indices. You can take different stocks, if your analysis method is general enough to work in all of these markets, then that's beautiful. That's awesome. And lastly, this is one of those things that I can't emphasize enough. It's got to be relatively easy to interpret. So I'm going to show you what I mean with this. But if it's something very difficult to decipher, and I have seen this happen so many times. A friend came to me saying that, there's this beautiful trading system. And she went on about it often, that it's so great. I finally said, let's take a look at it together. Because she was also saying that, okay, I just can't get my head around it, but it looks wonderful. So it was something like this. Let me bring this up for you. It really was something like this. I think actually it was just worse. So basically it was a chart full of squiggly lines. There was so many different rules that I think it was really designed just to impress people. But if you are a real trader, if you have been trading the markets, you know that all these squiggly lines can be very distracting. First of all, you as a human person, as a human, you have only a limited capacity for computing power. Right? So if you have to consider this line and all those three lines and that line and these lines, and if you have to interpret all of those, then it's going to be very hard for you to react to the market in a correct manner. You might miss something that is actually really obvious in the market just because you have too much analysis on your charts. And then, okay, let's say that you like stochastics. Then you have to, and I'm not saying again that this isn't useful indicator, but you have to use it in moderation. But to illustrate a point, so look at this. There's a parameter for K, D, and smooth. So how do you know whether you should have here a value 12 or 24 or 17 or 3? And once you decide to a certain set of parameters, then you still don't know if it's going to be useful in your analysis. You just have to go back and test it. And that's a lot of work. So I'm going to show you something that is really easy, something that you can just, you see the chart and it makes you relax. Just a moment. Okay. Here we go. This is S&P 500 in daily time frame, and it's the futures chart here. All right. So one of the most powerful techniques is tracking these swing points. So very simply, if the market creates higher lows, higher swing points, then the market is likely to go higher, right? And as you can see here, market is finding support higher than here. So what do we understand about supply and demand? We understand that prices can't go higher if there's if prices can't go higher if there isn't more demand than supply. So let's think about this chart. What's happening here? Institutional traders, they manage, hundreds of millions, sometimes even billions, and even, tens of billions. But the thing is, there's only a certain amount of liquidity available in the market. So if you are a big fund buying the market, then even if we are talking about S&P 500, which is one of the, ES contract here, the mini futures contract, it's one of the most liquid futures markets there is at least in equity indices. But even there, if you start buying with hundreds of millions, obviously you push the price higher and your average price goes up, which means that your profit margins go down. So what the institutional traders do, they don't buy when the prices are going higher. they buy when the prices are going lower. So here, for instance, that's why you get these fluctuations here. After that correction lower, analysts in various banks and investment funds were thinking that, okay, this is just a correction. The market will soon find a, it's a dip to buy. When the markets move higher, you buy the dips. When the markets move lower, you sell the rallies. That's, that everybody should know that. Unfortunately, small traders don't. But yeah, so what happens here? Institutions start buying as the price comes lower. Then at some point, there will be a level where there is more demand than supply. All the little guys who were so afraid have sold all they have, and now the prices are ready to move higher. So that's how a swing point is created. The next time the price comes down, we have a fluctuation process again, and at some level, institutional buying becomes bigger than the retail selling, and the prices go higher again. And then again. That is something that repeats often, so often in markets, that it's a reliable mechanism for understanding where the momentum is going to. And then obviously you have the opposite too. When you have a lower swing point, and obviously you don't know that on this very bar, but you know it a little later. So let's use this. I'm gonna go use the replay tool on this. Come on, I thought this works like. Yeah, maybe I have to close that, do this again, go here. No, sorry guys, I can't get this working for some reason. But the idea is that you don't see the prices beyond that candle yet, so you can't know that it is a swing point. But when the price moves a little lower, you know that, okay, yeah, we do have a very potential swing point here. So it is possible that the prices now go lower, and ta-da, they do go. And they come down all the way down here. And actually, I remember this time, I alerted my traders or TO market traders here that we have upside potential to this market somewhere here. And yet we had a swing point here that was higher than the previous one. So that indicated the prices are going to go higher. And then you have, like I said, there are periods when the market is more volatile, and then there are periods when the market is less volatile, like here. And you can see it often in S&P 500 that when the market, after a period of volatility, when it starts to grind its way higher, the volatility is kind of small compared to what it was before. The corrections are smaller, but this is a swing point that is higher than the previous one. Then you have a swing point that is higher than the previous one. And okay, market spikes down here, but then again moves higher. So with this kind of method, you can always understand where the price is going, and you don't need this. This doesn't add any value, all this mess here, right? So again, you have seen me using stochastics, for instance, and moving averages. I have nothing against them. I'm just saying don't overload your charts, but learn to read the price. Because with all the analysis, it's the price that is the key, because you can't argue about the price. You can argue about interpretations here with the indicators. You can argue about different sets of parameters, but the price is what it is. So it's highly, highly valuable. Okay, so I promised to talk to you about measuring momentum with these market structure things. It's like trends and changes. Momentum changes over time. It never stays the same. So let me just take you to some examples here so that you understand how you can measure momentum with the market structure. Okay, let's use this Euro USD daily chart as an example. So starting from here, The price is moving a little lower. You can see the lower swing highs here. But then something happens. Here we have a support that's not penetrated. What happens when the market can't move lower? It can either move sideways or it can move higher. So from that point, it didn't look back. So the market rallies up and then retraces. So what do you understand is taking place here? Some people are taking profits off the table, thinking that, yeah, this was a quite nice move and we don't know what's going to happen next. But then the market creates something here, something that we have been looking at. At least on this candle, you know that this is a potential higher low. And the market keeps on moving higher, and then there's yet another one higher low, another higher low. So 2 swing points telling you that momentum is building up. It's not likely to move sideways anymore. And actually, this spike higher was the first indication that, yes, we might get actually beyond these resistances here. So obviously, look at this. You have a swing high there that was penetrated. Then you have higher lows. So just with these higher lows, you can understand that the momentum is building higher. And then we get a breakthrough. We get a test of this level. And then bang, the market moves. Bang, 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 higher. Really nicely higher. And then again, after the retracement, we have a higher swing point. So after all of these higher swing points, you can say with certain confidence that there is good probability that the price will move higher. So these are valuable indications. And then this keeps on repeating. Then we have there another swing point. And once again, remember, we don't know it on this very candle. We know it afterwards. But that is something that you have to keep an eye on because it tells you a valuable story. And then the last one is here. There's a small rally after this. And something interesting happens here. Most of you who have traded this market lately can actually spot this. Let me go and take a trend line here and just use the trend line tool. So what is happening? We have market coming below the trend line and then the opposite starts to happen. The market comes down, rallies, and creates a swing point that is bearish, right? The market is now in a different mode than it was here. And now it makes more sense to actually be a seller. So remember, when the market is moving higher, you want to buy the dips. When the market is moving lower, you want to sell the rallies. So this is what it means. And then again, another swing point there. But because this low here is higher low than this, we get a more rally, which kind of moves quite high actually, and then the market fails. Okay, that is tricky. It needs obviously your attention. You need to be able to understand. You need to be able to recognize these situations and understand that the market does this every now and then. It's not as simple that you just keep on buying, and then you just keep on selling. Yeah, it's unfortunately it's not that easy. But then another swing point, which is lower than the one before, and this keeps on repeating. So it is a highly valuable tool for you so that you understand, you get a good understanding where the market is likely to move to. You never know for sure where the market's going to go. Only thing you can have in the markets, the only luxury you can have is to have the probabilities on your side. And that's why you do analysis. That's why you use moving averages. You can use trend lines, but use them all the tools you need to use in moderation, right? So that's one, I think that is a very, very fundamentally important tool for you. Keep on studying the markets. Go back in charts and learn how to do this, right? Because obviously I'm not cherry picking here these examples. I'm saying this is something that I see highly valuable. For me, is as I do analysis, and as you have been following my analysis on tomarkets.com/analysis, you know that it is constantly successful. I don't get it right every time, but nobody gets. If somebody tells you something else, he's lying. It's as simple as that. Yeah, cool. Okay, so let's move on. Like I said, you can add indicator analysis to this. There's nothing wrong with the indicators if you know how to use them. Just not overload your charts there. So let me add a couple of indicators here, a couple of moving averages. I'm often using 20 and 50 period moving averages in my charts, as you have seen. So what can we understand about the moving averages here? They kind of confirm what you are seeing in the price action taking place. Because here we have a higher low, and because of this rally, that the red line, the 20 period moving average, is crossing above the 50. So this will follow the price higher, and now we have even higher low, so we are gaining some traction here. There is difference here. The red one is taking off, and the distance between these two is increasing. So you have momentum growing there. Then price closes below the moving average. That's the first time it has happened for quite some time, so it's a negative sign. And then the price starts to move below the moving average. Okay, that's negative. Then we get a swing point here that is lower here, and yes, it's basically indicating even more bearishness. So all the time you have these indications that the market is more likely to move lower, and you have the red moving average sort of tracking the price, getting closer to the 50. Then there's a cross below the 50 period, and we have yet another lower swing point there. Okay, that was a bit of a jump there, so that happens every now and then. The market is what it is, but we just have to wait for the market to tell us more about what's happening here. Then we get another here, and just to remind you guys that you can only know these after the fact. I'm going to move these a little bit so that you understand that this is a swing point here, and then that's a higher swing point, so that kind of breaks the sequence, and then we have to wait for a lower swing point here, and I'm going to move this a bit. So this is a lagging indicator in a sense, but it gives you a good understanding when you combine all these things together, that yes, the market is likely to move to a certain direction. And yeah, so you can see the trend line breaking. You can see that there are no more higher lows or swing points that are higher than the previous ones. You can see the price is trading below the moving average. The moving average is pointing lower. A lot of things that you can use to create your understanding of what price action is doing. So one more thing about these key swing points. They sometimes work as resistance levels. There you have a resistance, and the price moves lower. Yeah. So they don't always, like here, the market kind of penetrates the level a little bit, but then moves lower again. So it's giving you some guidance. The market actually reacted to this low at the time and then started moving lower. So it's probably, the way I look at markets is that it gives you hints. It gives you little clues where it's going to. But you have to put these little pieces of a puzzle together to get a full picture of what's happening in the price. And that's how you can build a pretty good understanding what's happening with the momentum. And then the price can actually give you early warnings, because I promised to talk about price formations too. So we have spent already quite a bit of time here, but I'm going to cover at least one price formation, and that is a wedge. So bearish wedge here. Like this. If you combine these two tops and then extend, it kind of cuts those highs there. But the message is clear. If you don't believe it, if you have some difficulties understanding what's going on there, you can always take a look at other types of charts, go to line chart, and maybe it gives you more understanding of what's going on. But this is, most of the time, the candlesticks are good enough to seeing what's going on in the market. So, what is actually happening here? The first rally was big. Yes, then there was a retracement, but then the next rally was kind of sluggish. It only moved slightly above the previous peak. That's why we get the upper end. The slope on the other end is smaller than the slope at the bottom end. So there is a pressure building against this bottom end of the bearish wedge, and eventually the market breaks out. So this here is yet another indication. It's just giving you, it's not a reason to sell the market, but it's giving you an understanding that yes, maybe the bulls are running out of steam. Maybe the institutions are selling upstream here. And yes, indeed, that looks like it was the case. The market dropped lower, and then we have more bearish indications. And here we have the distance between the moving averages widening. So all these things put together, they will help you to understand what's going on in the markets. Okay, as you can see here, these signals or indications are so frequent enough. They're not signals really, sorry, that's a wrong term, but they are indications of what's likely to happen in price. They are so frequent that they appear quite often. And obviously, if you want more activity for your trading day, you go to intraday charts. I'm using these daily charts because they're very clear and they give you an easy understanding of what's going on. And also because the institutions are using daily and weekly charts mainly. They drive the market, they move big positions around, so they're not interested in 20 pips, they look rather for 300-400 pips in euro. So now we have one of the criteria is filled here. It's like you've seen, it's general enough to be valid in multiple markets, in multiple or different market regimes. We haven't had time to go through all the different markets, but all the markets fluctuate, All the markets rally higher, retrace back, rally higher, retrace back, rally higher, retrace back. There is absolutely no free market that doesn't do it. So this is something that works in most of the markets. It works in most of the time frames. If you go too small time frames, then those are quite messy. There's a lot of noise instead of signals, so to speak, and then things get a little trickier. But if you stay in, say, 2-hour, 4-hour daily charts, maybe 1-hour charts, don't go much deeper than that because it gets more tricky. So then you can read the market using these principles. So it's robust enough for different markets, and it works in different market regimes. Like here you can see the market is ranging sideways, and you can still use this analysis. Market is trending higher, you can use it. Market is trending sideways here again, or ranging sideways, and it helps you. And when market goes down, it helps you again. So when you have a moment, email me at support@tomarkets.com and let me know if you have further questions, if you have any ideas or questions that you want an answer for, or if you have some ideas for future videos. And if you are watching this now real time, you can obviously here in the chat box, type your questions in, and I take the questions if I have time for them. But we are running out of time, so let me be just as quick as I can possibly be. And yeah, one more thing. We talked about, let's go here. The analysis method being useful if it's relatively easy to interpret, right? So it really, in my opinion, this compared to this is gold. I mean, this is rubbish. Who wants this? I don't want to see charts like this. I couldn't live my trading days with charts like this. But if you concentrate on a certain period of time only, and you get some very clear signals that nobody can argue about, signals again is a wrong word, but indications. So by this time you know that there's a higher low there, by this time you know that there's a higher low there, by this time you know that there's a higher low there, and that's how it works. That's how it works. So like here, okay, you might argue that the bar closes there and then the market just comes down. Okay, it happens because the markets work like this. There's no way around it. So, but it is valuable information still. When the market comes down here, you might want to buy against this low, but you might get stopped out. But then you have information that this level was important, and the market then reacts negatively when the price action develops. Okay, so that's valuable information. Excuse me. So, what else? It's robust enough, frequent enough, general enough, and relatively easy to interpret, right? I guess it's time to start wrapping up now. Really, we have spent quite a bit of time here, so I really want to just mention a couple of things, and then, I mean, you know, it's always stuff that you will find useful. Just a moment, I'm going to bring up a couple of slides here. This is the first one. So subscribe to our Telegram channel. So this is a must because we publish new stuff on daily basis and you need to know about it immediately. So if you subscribe to our Telegram channel, you get an alert. Let me give you here. That's the channel there. So t.me/teomarkets_announcements, and that's how you find us in Telegram. So well worth going there. And then also another place where you should go is our YouTube channel. There's a weekly video nowadays. You can always benefit from the analysis there. Even if you go and study the previous analysis, I'm always using the same methods because I don't jump from one thing to another like most traders do. I use something that I know that works. You know, I know it works. So that's why I'm publishing. I'm putting my reputation and company's reputation online, and it's been successful. So why shouldn't I? Why should I use something that is a little bit iffy? I don't know if it works or not. I'm not going to do that. I'm not going to sacrifice the reputation of my company or myself. That's why I'm always using the same methods when I write analysis or make videos. And you can go back and see that there are times when the market moved differently than I was expecting it to, but that's life. I mean, if you are expecting something else from Mrs. Market, then, I mean, you live in Fantasyland. You just have to accept that the market, Mrs. Market, does what she wants to. And we just need to kind of get an idea of what's going on, where the wind is blowing today from, and then we understand, okay, it's this kind of day. We're gonna go higher today, so let's keep on buying. So that's what you do with the markets. Cool. Yeah, so it's been a wonderful 40 something, almost 45 minutes together, and I really hope that you found this useful. Let me know what you think, and if you're watching this later on video, email support@teomarkets.com and ask questions. Those questions will be passed on to me, and I'm more than happy to answer the questions or include them into future videos and webinars. So, excellent. I wish that you will trade safe, never trade without stops, and do not over leverage your trades. Make sure that you learn day by day to become better and better in understanding the market and in your risk management and your strategy execution. And that's why you can define yourself as being successful. And that's how you can build up those ladders that help you to become even more successful over the months and years to come. Cool. I look forward to seeing you in the next webinar. Take care.